On Monday evening, Circle, the company behind the second largest stablecoin, lost 17.5% of its market value in a few hours. Nobody hacked anything. 140 companies, Visa, Mastercard, Stripe, BlackRock, Google announced they are launching their own dollar stablecoin. This is Signals Weekly. 4 stories that actually matter if you move money across borders. No prices, no predictions, no financial advice. What happened, why it matters, and what to check in your own payment process. Let's go. Story 1. The consortium coin. 140 companies, including the biggest card networks and the biggest asset manager on the planet, launched OpenUSD, a stablecoin. None of them controls a loan. Why would competitors share a coin? Because the alternative is worse. Every one of them building on rails owned by someone else. A shared stablecoin is not a product play. It is an infrastructure play like Visa itself was, when banks that hated each other built a shared network in the 60s. Circle's 17% drop is the market repricing one question. If the giants share their own coin, who still needs an independent issuer? That question is not answered yet. But if your business builds on any single stablecoin, this week was a reminder: issue risk is real, and it is not a crypto-only risk. It is a counterparty risk. Practical check. Know which stablecoin your payment route depends on, and know your exit. If that issuer changed terms tomorrow, how fast could you switch? If the answer is no idea, that is this week's homework. Story 2. Europe. On July 1st, the transition period under MiCA Europe's crypto regulation ended. Tether chose not to apply for the required e-money license. Result: USDT is now delisted from regulated European exchanges. Important precision: holding USDT in Europe is not illegal. Peer-to-peer transfers still work. What closed is the regulated on-ramp and off-ramp, the ability to convert through licensed venues. That distinction matters for anyone whose European counterparty says, just send USDT, like before. If you pay or get paid by European companies in USDT, ask them now, not on invoice day, how they convert. If their answer relies on a venue that just delisted, your payment will technically arrive and then get stuck one step before their bank account. The transfer isn't the risk. The last mile is: check for this week. For every EU counterparty, confirm their current off-ramp in writing. One sentence in an email. It can save you a frozen settlement. Story 3. Mastercard launched Agent Pay for machines payment rails, where the buyer is not a person, but an AI agent. Software negotiating, ordering, and paying other software in the background, while you sleep. This is bigger than it sounds. Once agents pay agents, the number of transactions explodes and the size of each one shrinks. Micropayments, thousands per day, no human looking at any single one. The efficiency is obvious. So is the new failure mode. Nobody notices the hundreds small wrong payments that add up to one big loss. We build agent-driven transfers ourselves. So here is the rule we run in production. Agents execute, humans authorize. Small amounts can go through on session-level trust. Anything above a threshold needs a personal signature. The agent prepares everything, the human owns the final yes. If you are adding AI to your payment flow this year, copy that boundary before you copy the automation. Decide what the agent may never do first, in writing, then in code. Story 4. Nigeria. The central bank announced a working group to build a stablecoin framework. 3 years ago, this same regulator cut banks off from crypto entirely. Now it is writing rules for it. What changed is not ideology, it is arithmetic. Nigeria received roughly $59 billion in crypto inflows in a single year and accounts for about 60% of stablecoin inflows in sub-Saharan Africa. Businesses did not wait for permission. USDT became working capital while the paperwork caught up. At that scale, a regulator has two options: supervise it or watch it route around you. Same week, next door, Tether invested in Kotani Pay, a Kenyan settlement startup, while Kenya runs a national consultation on digital asset rules. Issuers and regulators are converging on the same corridors. The ones who are sending money still cost 6% plus in fees and days in delays. Rules get written where the pain is worst. That is usually the sign a market is real. What it means in practice. Regulated rails are coming to African corridors. When frameworks land, onboarding will favor businesses with clean payment, disciplined documented counterparties, test transfers, audit-ready records. Start keeping those records now, and licensing season will be a formality instead of a retrofit. Scam radar. This week. Address poisoning. A trader sent $50 million in USDT to an address that looked exactly like one he had used before. One copy-paste. Gone. The mechanic. Attackers send you dust transactions from an address crafted to match the first and last characters of your real counterparty. Your wallet history now contains a lookalike. Next payment day, you copy from history, and the lookalike wins. After this 50 million case, exchanges are pushing wallets to block poisoned addresses by default. Good, but defaults will not save you this quarter. Defense is boring and it works. Pay only from a verified address book, never from transaction history. Verify new addresses through a known contact, not the chat that delivered them, and check more than the first and last 4 characters. That is exactly the part attackers fake. That's the week. The giants pulled the coin, Europe closed the door, machines started paying machines, and Nigeria started writing rules. 4 stories. 1 threat payment discipline beats payment speed. The 60-second pre-flight checklist we use before any USDT transfer is linked in the description free. 1 page. Signals Weekly comes out every Friday. See you in 7 days.